are the 5 important things to know to build wealth with life insurance. Now, the reason I'm making this video is to demystify the process of using life insurance to build wealth. And the reason why I need to demystify it is because there's a whole bunch of stuff floating out there on the internet, tons of YouTube videos. Some of those videos they miss a lot of important information. And so what I want to do in this video is do a really deep dive. I'm not sure how long this is going to be. This is straight to tape or straight to recording. There's no editing here. I'm just going to go through it. Again, I'm going to give you 5 important things you need to know to build wealth with life insurance. Now, they may call this process infinite banking, velocity banking, bank on yourself. These are all just creative marketing terminology that they're using to describe the same process. So don't allow the terminology that's used to describe this process to confuse you, because there's enough that you need to be worried about in using the process. Okay, so again, I'm going to give you the 5 important things you need to know to, I should probably say, properly build wealth with life insurance. Okay, so let's go ahead and dive in. First thing you need to know are the different policy types. Not all policies are going to be best suited for this process. Okay, now there are 6 different life insurance death benefit plans. They're subdivided into 2 main categories. You have your death benefit only plans, which I've indicated on the left side of the screen. There are 2 types of death benefit plans, one known as term life, which everyone I'm sure knows about. The other one is known as return of premium life insurance. We don't want to use term insurance. We can't use term insurance because term insurance is temporary insurance. It's like renting an apartment. You're not going to be able to build any equity in a rental, right? If you're renting an apartment, you're not going to build any equity. The equity accumulation is for the owner of that apartment, okay? So think of your term insurance policy as a rental. It's temporary insurance. Where you want to focus your attention is on the policies that have a savings account or a savings mechanism attached to them. Now, there are 4 types of death benefit and savings plans known as permanent life insurance policies. You have your whole life, your universal life, variable universal life, and index universal life. Now, in most cases, when you hear about life insurance being used for wealth accumulation, the focus is going to be either on the whole life or the IUL. Now, there are some people out there that say you shouldn't use IUL or you shouldn't use whole life. Here is the deal. As your advisor, I don't care what you use, right? I think you as a consumer need to make an informed decision after you've received full information. So what I'm going to focus on today, however, is going to be the IUL type, because I personally like it. I love the flexibility that clients have. I also like that the IUL has consistently outperformed the whole life. However, we're going to kind of keep this as general as possible so that you can hopefully have enough information to make an informed decision. So again, we're going to talk about how you can make use of these death benefit and savings plans to start to accumulate wealth. Okay, now we understand this is the first thing. Remember, first thing is first. You need to know what policy types are out there. We can't use term. We have to use a policy that has a savings account. 4 of them exist. We're going to talk mostly about IUL, but remember, these things that I'm teaching today can also be applicable in most cases to whole life as well. Okay, so now you have the correct policy. So let's say you have the correct policy. So you have a policy with a savings account, either an IUL or a whole life policy. Second thing is you need to make sure that that policy is properly designed. Okay, now you might have heard, you might be on, some blog post, or you might have watched some YouTube videos. There's one out there with Dave Ramsey talking about infinite banking doesn't work. All of this stuff doesn't work. But that statement requires a bit of qualification. We need to make sure that the policy is properly designed. Think about it this way. I like to use this example in my workshop that I do each week. Let's say, for example, you go to the car dealership and you are a Cadillac man or woman. You like Cadillacs, right? Matter of fact, let's not use Cadillac. Let's use a Mercedes. You are an S500 Mercedes fan, right? Two individuals walk into the same car lot and buy the same exact year, make, and model Mercedes. Same color, same finishes. But guess what? Does that say or does that tell you that they have exactly the same vehicle? Right? Think about that. No, it doesn't. Just because you have the same color, same year, make, and model doesn't mean that we have exactly the same vehicle. Your car might be fully loaded, mine's may not be. Yours might have leather trim, mine's may not. That is what I'm talking about when I say your policy, after you have the correct policy, it needs to be properly designed. Now, what do I mean by having a policy with a savings account? Remember, that's what we're talking about. Having a policy with a savings account that is properly designed. That is referring to what's called the Mech Rule. This Mech Rule is also known as Section 7702 of the Internal Revenue Code. Now, 7702 basically states, and I'm just going to put this in layman's term, that in order for you to use a life insurance policy as an investment vehicle, you have to have a minimum amount of death insurance per dollar of premium that you invest in that policy. Now, let me give you some background on Section 7702 so that can make better sense to you. Back in around, I think it was like 1980, 1982, okay? Prior to 1982, there were policies with savings accounts, but people were abusing those policies from a income tax perspective. People were putting all of this money into these life insurance contracts, but because there wasn't an IRS rule or any type of legislation in place, people were putting a lot of money into these insurance policies. These policies were growing, and they were taking the money out and not paying any federal or state income tax. So the Section 7702 was enacted by the Internal Revenue to prevent life insurance policies from being abused. In other words, the government wasn't getting their tax revenue from these policies. So 7702 is sort of the guardrail that is also used to help you structure the policy correctly. Okay, so for every dollar you put into your life insurance contract, now don't try to understand this now if you're not understanding this. I'm going to break this down to you in the next couple of slides. For every dollar you put into a life insurance policy contract, you have to have a certain amount of death benefit. So you have a minimum amount of life insurance that is required in order for that policy to be compliant to IRS tax rules, okay? So now, 7702 is the Mech Rule. It establishes a minimum amount of death benefit per dollar of premium that you put in. It also restricts the amount of premium that you can invest into the policy per the amount of specified death benefit that you have. Now, this is all very legalese. I get that. So let me kind of take you to the next slide so this can make better sense to you. The MEC is important, okay? Before I go to the next slide, the MEC is important because it allows you to use the policy as long as you follow the rules, and the income, growth, and death benefit are all tax-free. I don't know why I didn't put this on the slide. Following the MEC means that the income, meaning any monies that you pull out of the policy are tax-free. Any growth that you accumulate in the policy is tax-free. And the death benefit that's ultimately paid out of the policy, assuming that there's any death benefit left and you haven't taken all of the income out, that money is tax-free, and that's actually per Section 101A-1. That makes the death benefit of life insurance tax-free. So by following Section 7702, it allows you to take the income, to have the growth, and death benefit paid out tax-free in later years. So you may have heard of the term a non-MEC policy. That means a policy that is compliant to Rule 7702. Now, we follow MEC we use Mech as a guideline to help us establish how much premium we can put into the policy at any given time. And then from there, we can begin to project out what the income and the growth will ultimately be. So now let me kind of dive a little bit deeper, and so you can understand how the Mech rule applies to how you're structuring your life insurance policy. So again, remember, we are having a policy that is a Mech compliant policy, a 7702 compliant policy. By the way, sometimes before I go into this, you may also have heard of the policies being called 770 plans. That's the same exact things as I'm talking about today. It's essentially the same thing. You have a life insurance policy with a death benefit that is compliant to Rule 7702, and you are maximizing the funding of that policy within the guardrails of the IRS rules so that you can take the income growth and death benefit out tax-free. Now, let's show you how this works and how the Mech rule will help guide how you structure the policy and why it is so important. On the screen, I have what's called a mortality curve. Okay, a mortality curve plots your age against the cost of insurance. So it relates your age to the cost of insurance, or vice versa, the cost of insurance to your age. This blue little shaded area down at the bottom represents how the cost of insurance increases over time. Now, we know that when you buy insurance at 22, it's going to be less expensive than when you buy it at 42. So what we're doing with the Mech rule is we are establishing a guideline where we can begin to fund a policy that has a savings account. And what we want to do is we want to minimize the amount of insurance cost as much as possible. The reason why we want to do that is because if we have a policy that is, say, for example, we're funding a policy, but we do not have a minimum death benefit, what ends up happening is that you could fund a policy and not end up having any money in the savings account. You might not have any money in the cash value. So what that means is that when we go to overfund or go to fund our life insurance policy with a savings account, we want the cost of insurance to be as low as possible. And stated another way, we want to have the death benefit be as low as possible. The IRS doesn't say what the death benefit has to be. It just says it needs to be the minimum death benefit. So the minimum death benefit in this example is $100,000. So let me give you all this example before I go any further. What I'm saying is you can have two individuals, individual A and individual B, right? Individual A has a $200,000 death benefit policy with a savings account, right? So let's say both of them have an IUL. Individual A has an IUL, individual B has an IUL. Let's say individual A has an IUL with a death benefit of $200,000. Let's say individual B has what I'm showing you on the screen, a death benefit of $100,000. Let's assume further that both individuals are investing, say, $400 a month into their IUL. Now remember, the first person had a $250,000 death benefit. The second person is the person on the screen with a $100,000 death benefit. Well, guess who is going to have the most cash value at the end of 10 years? It's going to be this person with the $100,000 death benefit, because the individual that has the $200,000 death benefit, this blue line or these little blue spaces right here are going to be a little bit higher, right? Meaning less of the money that they're paying into the policy is actually going into the savings account. The purpose of this is so that we build the savings account. The death benefit is a secondary concern. If we want to have a high death benefit, you can get a term policy for that. We don't want a lot of death benefit in an IUL or a whole life policy, because the higher the death benefit, the lower the amount that is ultimately going into that cash value. So we want to minimize that death benefit and as much as possible per the amount of premium that we're putting in. And that is another difference between an IUL and a whole life policy is you have a couple of different options or ways of minimizing that death benefit. Now, let me show you how this works. Now that we understand we want to keep our death benefit as low as possible. Remember, two individuals can have the same exact premium. One have a higher death benefit, the other one have a lower death benefit. The person with the lower death benefit is going to build their savings much more quickly. Now, we're going to use $400 for example here. So let's assume that we have the cost of insurance that is growing over time. This is another thing I want to say to you all. The cost of insurance is not a static number. So when you start your policy, your cost of insurance might be one thing this year. Next year it's going to be a little bit more. The year after that it's going to be a little bit more. That is not a static number. The cost of insurance increases each year as you get older. So if you want to build the savings or the cash value in that life insurance policy, guess when is the best time to do that? You want to do it out here when these blue lines are small, so that we have more of that money going into the savings account, okay? So again, that orange line is the premium that you're putting in. The blue spaces at the bottom is what's represented as the cost of insurance. That's how much the life insurance company subtracts from your premium before they allocate it into the savings account. Now let's keep going forward here. Remember, we're starting this with a $100,000 death benefit because we want most of the money going into our savings account. So what's going to happen is we're going to continue to do our $400 a month. We're going to build our cash value because the premium that we're investing is more than the cost of insurance. That's how we build our cash value. Now, what's going to happen, however, is, remember, we got two things here. We have the death benefit, but we also have the savings account. When you pass away, your beneficiaries will receive the cash value and the death benefit. Those both will be paid out. They won't receive two checks. It'll be one check for the total amount. Now, there's what's called an option A and an option B. I won't get into that today, but what that does is it allows you to adjust the death benefit of the policy in later years. Because think about it this way, this $100,000 death benefit is from day one when you have no savings. But what's going to happen is as you're building that policy up through a combination of your contributions monthly and your quarterly contributions and the interest that's being earned on that index account, guess what's going to happen? Your death benefit is going to grow over time. You started at a $100,000 death benefit, but say 20 years down the line, using an option B, your death benefit is going to be higher. So guess what we want to do 20 years from now? We want to what? Decrease our death benefit, because as your savings account grows, as your cash value grows, the IRS requires that the life insurance company add what? Additional death benefit coverage. And guess what that does, everybody? That what? Increases the internal cost of the policy. So what that means is you start at a $100,000 death benefit day zero. 20 years from now, assuming that you've established it as a minimum face plan initially with an option B set up. Again, I won't get into that today. You can attend my workshop and I'll break that down for you. Your death benefit is going to increase. So guess what we're going to do? As we're growing our savings account, the death benefit is going to go higher and higher and higher. But guess what we're going to do once it's time for us to take income out of the policy? Let's assume you're using this policy for retirement income. What you want to do is you want to drop that face amount. You want to decrease that face in later years, and you want to put as much money into that policy as possible. Now, in this example, I'm showing you a $400 a month premium going in, okay? That may not be your Mech limit. Your Mech limit is the maximum that you can put into the policy. That's different than overfunding. See, so let me say this again. Just because you're overfunding your policy doesn't mean that you're max funding your policy. This is an example of overfunding. I am doing $400 a month. That's greater than my mortality cost. I'm building my cash value. But your MEC limit is an IRS established limit based on how you start the policy. So your MEC limit could be double or triple what you're currently putting in. And that's why I advise clients to hit your MEC limit early. Why? Because your cost of insurance is lower in earlier years. So instead of you doing 400 or 500 or 600 a month, max out your policy in earlier years, because guess what? If you try to max it out over here, the cost of insurance has went up more. So that same amount of money that you put into the policy in later years is not going to go as far. Okay, now we keep going forward here. Now let me show you how this works here again. This is, I know, probably new for some of you, but what I like to do is I want to give you the rule, the concept, and then I'm going to give you the real example. So remember again, before we go to the next slide where I show you the example, as we're building up our policy, we want to start with the lowest death benefit possible. You have usually level death benefit option or option B, which is increase in death benefit. You always want to do the increase in death benefit because that is going to, yes, increase your death benefit in later years, but what that also does is it allows you to put more money into the policy. Okay, so you always are walking this balanced act between death benefit and cash accumulation. Started off low death benefit, minimum death benefit. It will grow over time. As it grows, what we want to do is we want to do a face drop. The face drop typically happens again around the time you're ready to start taking retirement income out of the policy. And remember, we always want to make sure, if possible, that we hit that 7702 MEC limit in earlier years, out here, not out here, so that we can preserve the integrity of our cash value in later years. Okay, now let me give you an example on the next slide of how this works. Okay, so this is an example of a 61-year-old male, okay, who is max funding their policy for a total of 9 years at $12,000 per year, which is what you see in the premium outlay column. If you sum up the first 12 all the way down to year 9, the last 12K investment, that is $108,000. Okay, look what happens if you draw your attention to the death benefit. Remember, we have the savings account plus the death benefit. So we see here that we have $12,000 going into the policy. Look right here, how much is in the cash value? $10,000. Guess where the other $2,000 went to, everybody? That cost of insurance that I just told you about, that little blue shaded area on the bottom of that mortality curve, that is where the difference went. That is why I say keep your death benefit low. So if this person had started their policy with at $200,000, guess what this number might have been? This number might have only been $8,000. You see, so in other words, keep it low. It is going to grow over time. Look over here, what's happening. Over time, that death benefit is growing, and it gets all the way up to $231,000 by the time this client reaches the age of 69, which is the last year that this client is going to invest in this policy. But you notice what we do here after the age of 69, in the very first year that this client starts to take money out of this policy, because again, we use this, my primary use of these policies is for retirement planning for most of my clients. So if we're using this for retirement planning, the objective is not really the death benefit. The objective is the income or the tax-free income benefit. So what we want to do is when we see that death benefit get really, we have to let it increase as we move forward in time, because as the cost of insurance increases, so does your allowable premium investment. So we want to have an increasing death benefit to allow us to put money in. But when we stop investing in that policy, we don't want this death benefit to just keep going up and up and up and up and up and up and up, because what that's going to do is it's going to negate this death benefit. It's going to negate your savings here. So what we want to do, this is why we have this pound symbol here. We do a face drop the first year that the client starts to take retirement income. And so what that does is it preserves the cash value of the policy. So this is what I'm getting at here. When you set up these policies, you have to manage these policies. You just can't go out and watch a YouTube video and have somebody sell you something, because what will happen is you'll buy that policy. They'll tell you the men face and all this kind of stuff, but they don't tell you that 20 years from now or 15 years from now, when it's time for you to start taking money out of that policy, if you do not change that death benefit, this is not going to work for you. That policy will blow up on you. So make sure that if you go out and get this, if you want to set this up, set it up properly and make sure that you're managing that policy. Make sure that your advisor, whoever it is you're working with, can guide you through this process. You need to be speaking with someone every year. You need to be monitoring your cash value growth. And you need to make sure that when it is time to drop that face, assuming that you have an increase in death benefit option, which you should in most cases, that face is dropped down so that it does not cannibalize your cash value, okay? Now, I beat that dead horse. So now we know, first thing is we need to make sure we have the correct policy. Second thing is we need to make sure it is properly designed. Now, let's get to the third bullet point, which is adequately funding your policy. Now, this is where, even if you get the first two correct, this is where a lot of people just don't get it right. Okay, they don't understand that you have to fund your policy. You have to adequately fund your policy. You have to manage that policy as an investment, just like you would monitor your 401k statement, okay? Just like you look at your Fidelity, your Vanguard, all of those statements. You need to make sure you're adequately funding your insurance policy, and you need to make sure that you pay attention to these three bullet points here, okay? First bullet point is, now, let me say this before I speak to this point. I get these questions often, so these are not just pie in the sky questions that I'm just formulating here. Everyone asks me these same questions. So first thing is this. I get this question, okay, Jerry, how long before I can begin to take money out of my life insurance policy? So let's say you set it up as a men-face plan with an increasing death benefit, which is option B. You do that option where the death benefit is increasing as you're paying into the policy. That allows you to put more money into the policy. When it's time to take money out, you drop that face. Now, I say to clients, if you are not able to wait at least 10 to 12 years before you start using your cash value, I do not recommend you use a life insurance policy for retirement or anything else. You need to give the policy sufficient time to grow the cash value. The first 10 years of your life insurance policy contract is not going to be the time where you're going to see a significant amount of growth. It usually takes, depending on the policy, depending on the company, it usually takes sometime between 7 and 10 years before your cash value is greater than the amount of money that you put into the policy. Now, another thing you want to keep in mind, that adding more money to your policy in earlier years can help your cash value grow more quickly. Now, you all should know why that is, right? Why? Because your cost of insurance is lower in earlier years. So the best time to max fund your policy is when you first start your policy, and you need to give it typically 10 years. Now, if you max fund it very heavily early on, then you might be able to start taking money out 5 years. So your break-even point is going to depend on how you fund the policy. For most people, it's 10 years before you can start to really see that snowballing in your cash value. I really caught this is a little redundant here, but whatever. You must consistently max fund or overfund your policy annually. Okay. Now, you can watch these YouTube videos about using your life insurance to build wealth and all this kind of stuff. Let me tell you this. You set up this policy. Look, you have to manage this policy. You have to pay into this policy, and you have to follow the illustration to the T. Now, I've had situations where clients, and you all got to excuse this thing here, I have to plug in my laptop. I had situations where clients will come to me, we set up the policy, and then after 3 or 4 months, they get return checks and stuff. Now, I'm not trying to be funny, but if you're not ready to be consistent with your plan, do not start your plan. Start your plan when you know for sure you're going to be able to be consistent, because most people that you go to out there that you read, you're watching these YouTube videos, they don't set these policies up every single day like I do. They don't have hundreds and hundreds and thousands of people that they speak to and that they coach on this process like I do every single week in my Black Wealth Bootcamp workshop. In order for this process to work for you, you have to consistently fund your plan, and you have to be financially prepared to do that. If you're not able to invest between $5,000 and $10,000 annual, and that really should be the minimum. If you can't invest a minimum of $5,000 to $10,000 a year into a policy with a savings account, this will not work for you. Now, let me kind of give you all a caveat. The caveat is if you're younger. Now, if you're younger, you may be 30, 25, something like that. You don't have to be as aggressive to get to the same result as, say, a person who is 40, 50, or 60. But the main thing is more money is better than less money. So if you're asking me what is the minimum I can start my policy with, then this is not the best fit for you. Okay, so make sure you fund your policy consistently and sufficiently. Consistently and sufficiently for this strategy to work for you. Okay, now let me show you, give you an example of why I say funding your policy early on, putting as much money into your policy early on is more advantageous than waiting until later years to do it. Look at this example using the same tool. This is a different individual, a 41-year-old that is overfunding their policy, $12,000 a year going in to the policy. We notice here that by the time 10 years has passed, this individual has invested $120,000 into the policy. But look, we only get to 126 in 11 years. So this is what I'm saying, right? That you need to give it at least 10 years before you see the amount of cash value equal or surpass the amount of premiums that you put into the policy. So you up here in 5 years, oh, I got $60,000 in this, I paid into this policy, and you look at your cash value is only, say, $50,000. Well, that other $10,000 is all cost of insurance that you've been paying over the 5 years. So life insurance policies are front loaded the first 10 years. Now, there's a way around this, and I've already told you all this before. Let's say you're like, hey, Jerry, look, I get that. How can I make it where my policy breaks even more quickly? I've already told you. This is an example of a 57-year-old, okay, who is doing $50,000, a $50,000 deposit into their policy, and they're investing $200 a month. Now look at what happens here. See how her break-even point, she put in $62,000 over 5 years, and look at her break-even point. Her break-even is about 5 years. So you see how we basically have cut the break-even time in half. Why? Because we added more money in earlier years when the cost of insurance was lower. Okay, so again, overfunding, max funding is great. When you overfund and max fund is just as important. Okay, max fund, overfund in earlier years, and lower your break-even time so that your policy can start that snowballing effect more quickly. And look what happens at year 10. We have $74,000 of total premium paid into the policy, and look, $83,000 of cash value. Now, I'm only showing you this to illustrate the break-even example. Okay, now if we were to show you the 15-year, the 20-year, and all of that, you'd see that this client would end up doubling and tripling her money, all because she basically funded this thing earlier. She overfunded it earlier. Okay, now we're almost wrapped up here. Let's talk about the distribution and withdrawal options. So this is the fourth thing. So we've already covered, okay, the correct policy type. We already covered how the policy needs to be it needs to be properly structured, meaning a minimum face policy that allows you to put more money in earlier years to maximize that cash accumulation. We've talked about how you need to fund that policy consistently so that you reach that break even point earlier, put as much money in as possible in those earlier years. Now it's time for us to start taking money out, right? So we've already covered the preliminary stuff. You know how to establish it. You know how to fund it. You understand what to expect the first 10 years. You know you're not going to get much accumulation until after 10 years, assuming that you don't overfund it or max fund it in earlier years. How do you take money out of the policy? This is another question that I get from people. So let me answer that question now. But in order to answer that question, I need to give you another rule. There's a rule in the IRS code that is essentially, it's in the same section of the Internal Revenue Code as the 7702 rule. 72E is the rule that allows you to take distributions from your policy tax-free if you take the money out as a policy loan. Okay, so technically speaking, the accumulation that you have inside of the cash value, anything above your basis, anything above what you put into the policy, is technically not tax free, it's tax deferred. We make it tax free by how we take the money out. And the way we're going to take the money out is we're going to take it out using a policy loan. Okay, so using the policy loan feature, it allows us to take the money or use that cash value without having to pay federal and or state income taxes. And the reason why this applies is because we followed Rule 7702. So see how everything ties together. When you follow Rule 7702, 72E applies, which allows you to take tax-free distributions from your policy in the form of policy loans. Now let's talk about these different loan or these different distribution options. This is, I'll guarantee you, you've never seen somebody explain. You probably maybe seen one or two videos out there. Everybody talks about making money, making money, making money. Build wealth with life insurance, build wealth with life insurance. But how in the hell do you get the money out of the policy? Because think about it this way. Think about it this way now. You all, I'm not going to go read this verbatim, but think about it this way. Let's say you own a home right now and your house has $300,000 of equity in it. You bought it 3 years ago. It's appreciated. You got $300,000 of equity. Is that equity of any benefit or any use to you if you can't use it? Is there, and if you can use it, if the HELOC or the refinance that you do has terms that are so unacceptable that you come out better not doing the refinance or using the HELOC, is that equity any good to you? So this is the point I'm getting at. Not only do we need to make sure that we're properly structuring the policy, that we're properly funding the policy, and all of that, we need to also examine what the distribution options are, more specifically the loan options. And these options will vary from insurance company to insurance company. This is important because how your policy loans are treated determine how much income you ultimately can take out of that policy. Now, there are, as you see here, 6 different types of distribution options. Okay. Now, we're not going to use the withdrawal option because, yeah, you're not going to pay any interest or anything on it, but at some point you might be subject to federal and or state income taxes because anything above your basis, meaning what you put into the policy, if you've invested $300,000 and you have a $600,000 cash value, 300,000 of that Uncle Sam is going to want a piece of the action. So we don't want to use withdrawals, although those withdrawals are quote unquote interest free. They're not quote unquote tax free, depending on what extent your policy value exceeds your basis. What we want to look at are the 5 loan options that are common amongst life insurance companies. Okay, so what we want to make sure, now I'm not going to get into which is better and all of that, but the main thing I want you to understand from this slide is that what loans are available to you can determine to what extent that policy is going to achieve the objective that was shown to you by that advisor. So make sure you are aware of the types of loans that are available. Is it a standard loan? Is it a participating fixed loan? Is it a variable loan? Is it an LIBR, which maybe 1 or 2 companies offer an LIBR loan? But the main thing you want to understand here is the distribution options available to you. They impact how much money you can take out of that policy, okay? Now, so here's the deal. 5th thing, final thing, okay? So we've covered a lot of ground so far. We've covered how the correct policy you need to use. We've covered that the policy needs to be properly structured, which means a minimum death benefit. You overfunding it in earlier years. We've covered how you need to adjust that death benefit in future years, to reduce that death benefit, do a face drop if necessary to preserve the integrity of that cash value. We've talked about all of those different things up to this point. The loan options available to you, you need to be aware of that. What we want to talk about now are the cash value growth options. So another big piece here, okay, that you need to think about is how does the cash value in your whole life or IUL grow over time? Because that is ultimately one of the most important aspects of the policy, if you're using it for wealth accumulation, is how the money is actually made in that savings account or that cash value. Now, here's the deal. Now, there are the whole life people and there are the IUL people. And like I always say, I am the advisor. It is not for me to make that decision for you. It is for me to give you the information for you to make your own decision. Now, let's talk about the difference between how cash value grows with a whole life policy versus how it grows with an IUL. With a whole life policy, okay, you only have a single growth option. It is what is known as the general account. The cash value that you have within a whole life policy pays what's called an annual declared rate and or dividend. Okay, some growth is guaranteed, but the rate of the growth is not guaranteed. Let me say it to you another way. Whole life companies have a long history of always paying interest. May not be a high interest rate, but it's very consistent. They're very consistent. So in times when you see interest rates increasing, or you see the equity values decreasing, or you see interest rates falling, whole life companies, the benefit to using a whole life company is that they're going to still pay you that 5%. So even if everything else goes to hell, they declare that interest rate and they're going to give you that interest rate. Now, you're going to see in a little bit how that interest rate has changed over time, but that's not what we're talking about right now. What we're talking about is how the cash value grows in the whole life versus IUL. So again, whole life companies will tend to pay you what's called an annual declared interest rate. It tends to be very consistent. Some growth can be guaranteed, but most of it is not guaranteed. Okay, so that's a big misconception. Oh, whole life is guaranteed. It sort of kind of is, but you don't really know to what extent. That they may say this year we're going to pay 4%, and then next year they might change it to 3%. They don't guarantee you what the rate is going to be. They just guarantee you that they're going to give you something, right? So that is the whole life setup. Another thing with whole life, you only have one option. You can't go to the whole life company and say, hey, I want to choose a different savings account within my policy. That doesn't exist. You either take the policy that you're presented or you don't. There is no way that you can change to something else, right, within that policy, within that life insurance company's portfolio, assuming they are a whole life insurance company that can give you a higher interest rate. They're going to pay that rate across all of their policies. Okay, so that's your whole life setup. Now, let's look at the IUL setup. The IUL is different in that it has multiple account options to grow your cash value. So you can actually, if you set up an IUL in most of the larger IUL companies out there, you could have 4, 5, 6, 7, 8 different savings account options available to you. And you can move in between those strategies. If you are in one account strategy and it's not doing well, or it's not doing as well as you would like for it to be doing, you can move into something else, right? So you have more options to grow your cash value with IUL. Also, unlike the whole life that more or less guarantees to pay you a set dividend rate, the growth rate in the IUL depends on the index account option selected and the performance of the underlying index, okay? So a lot of the index account options available with IUL can have bonuses attached to them. So it gives you the opportunity to earn bonus. It gives you the opportunity in many cases, in most cases, to significantly outperform the whole life. The downside is that the growth is non-guaranteed. Okay, with whole life, you are going to get some guaranteed growth. With IUL, however, you're not going to get any guaranteed growth. So that is where the risk is. And that's why maybe some people say, well, I don't want to do IUL because it's not guaranteed. Well, technically, whole life is not guaranteed either. I mean, it's guaranteed to a certain extent. If I tell you right now, I guarantee I'm going to pay you some money. If I tell you right now, I'm going to guarantee you I'm going to pay you some money. Does that tell you anything? Does that tell you how much money I'm going to pay you? I could be saying I'm going to pay you 50 cents. It could be $1, could be $1,000, could be $50. You don't know until they declare that rate. With the IUL, however, most of the time they have accounts that are tied to like S&P. They have accounts that are tied to BNP Paribas. Some of these indices out there, you can actually pull those indices up and you can more or less track the performance of those indices, okay, within your IUL policy without the risk associated with investing directly into the indices. So again, the difference between whole life is how the cash value grows. Multiple options with the IUL, only one option with the whole life. Whole life has more guarantees. IUL doesn't have guarantees. However, it gives you that flexibility to structure that account or divide that money up in such a way that you can ultimately outperform the whole life over a long period of time, okay? Now, what I want to do, this is another thing. I was actually speaking to a client, and she asked me, she said, well, can you tell me how the whole life, and I've actually had quite a few of my clients, can you tell me, Jerry, how the whole life policy has performed over, say, the last 15 or 20 years? Can you show me the difference between whole life and IUL in terms of the account, in terms of the cash value growth potential? So what I've done is I actually pulled an actual file, okay, that actually shows you the top 7 whole life insurance companies. And it shows you exactly what these companies have paid as their dividend interest rate going all the way back to 2003. So you don't have to, and again, you can call them up yourself and you can get this information, or you can just look at this, what I have on the screen here. Mass Mutual, Guardian, National Life of Vermont, New York Life, Northwestern Mutual, Ohio National, and Penn Mutual. There's a few other large whole life companies that are not included on this list, but for the most part, these are the top ones, okay? Now, what I want you to notice here is let's look at some of the years where we know the market was in turmoil. For example, in 2007 and 2008, right? When we know that there was the housing crisis with the inflated real estate values, they were giving mortgages out to everybody in the market tanked. You all remember that, most of you, right? Well, if you look at the index of the cash value performance of the whole life companies during that period of time was quite impressive, right? You were earning 7.5% on your cash value with Mass Mutual. You were earning same thing with Northwestern Mutual. You were earning basically between 6 and 7% on your cash value with amongst all of the major whole life companies. But here is the thing. This is where I want you to put your thinking. This is where I want you to put your thinking caps on. Now let's keep going forward in time. Let's look at 2020. Now, we all remember 2020, right? Shutdowns happened, the stock market crashed, all of that stuff. Look at what happened in 2020. Still, look at here. We're getting between 5% was the lowest number, all the way up to 6.2% with Mass Mutual. So if you look at these numbers, you're like, oh my goodness, this is great, because you would have still had significant interest credits to your cash value. Obviously, if you had your policy set up 20 years, 25 years, and you had 6 figures in your policy cash value account, then a 6% interest credit on a $200,000 cash value is $12,000 that you've essentially earned that year when everything else was going to hell. That looks good, right? But what I want you to look at here is the trend. Look at how, with all of, what do you notice in here? All of the dividend rates are on a downtrend. Look at this. So you look at Guardian, same difference. Dividend is on a downtrend. Look at all of these companies. So you notice, are you noticing something? Even though there's consistency with what they're paying, there's an overall trend that the dividend rate that you're receiving on these whole life policy cash values is actually decreasing. Now, does that mean that it's going to decrease for the next 20 years? No, it does not. But you can only base information off of past data. You can only look at a trend and make your decision. I mean, nobody can tell the future, but we can look at what's happened in the past, and we can sort of add some other variables in there and hopefully make an informed decision. But this is another reason why I don't particularly use or recommend whole life. However, I do like to show it because I think it's important for clients to see trend, not only what they're going to be earning, what they would have earned, but trends in those rates amongst the major whole life insurance companies. Okay, now let's flip over to the IUL. Now, this is one of my favorite companies that I like to use. Okay, this is a 30. Now, this particular company has 6 different index accounts. Now, this one is the one that I like to use. Obviously, clients can choose whatever, but I like to show this account. But what I want to draw your attention to here is you see how with the in the hypothetical interest credited column, this is the column you want to look at. This is what is used to calculate the rate. This is what is actually credited to the cash value in the corresponding time period. Look at this, everybody. Look at your 8.37%, but you see how it sort of bounces around a lot. Now, I want you to look at 2001. You didn't make much money in 2001, 2.9%. Look at 2020. You only made 7.69%. Still not bad, but look at what I'm showing you here. We don't have the consistency that we have with the whole life, but what we lack in consistency in the IUL, we make up for with higher interest earnings. Look at these double-digit years, 21, 22.91%, 13.16%. If you average all the 30 years of these interest credits starting from 1992 ending in 2021, your average compound annual rate of return was 8.07%. Now, I have not done the math on Mass Mutual, but I'm sure if you average all of these numbers, it is not going to be 8%. I don't care which of these companies you use. None of these averages will be 8.07%. So again, as I started off saying, I don't care what you use as a client. I want you to use what you're comfortable using, but I think it's important that before you make a decision that you to be locked into something for 10, 15, 20 years, that you have all of the available information, that you know exactly what the historical performance has been, that you know exactly what the loan options are, because all of that will ultimately affect your ability or impact your ability to use that cash value, and be it for infinite banking, if you want to use it for infinite banking, if you want to use it for retirement planning, it really doesn't matter. All of the things that I've taught you today still apply. You want to make sure that that policy is properly structured, that it's properly funded, that you know what the loan options are, and that you have a full understanding of how that cash value grows over time. Okay, I'm going to wrap up here. What I want to do now, I know this is really long. I'm going to give you all, I want you to go ahead and register. If you want to do a deeper dive, now this has really been a very technical, this has been a technical video, okay? I went a lot deeper than most advisors go because they want to make commission off of you. They don't actually want to teach you. I want to teach you something. Now, I am president and CEO of a Black Wealth Company. My passion, my mission is to help Black individuals and families create, retain, and transfer wealth using life insurance. And I do that using my life insurance wealth building classes. Again, I went very technical today, but what I'm going to do in the workshop is I'm going to give you even more information, because here's why this is important. Here's why this is important. I've given you everything about, I've shown you how to structure a policy, how to fund a policy. I've given you all that stuff today, but guess what? If you're drowning in credit card debt, how in the hell are you going to overfund a life insurance policy? If you do not have your 3 to 6 months reserves to carry you through an unexpected life event, how are you going to fund a life insurance policy the way you need to be funding a life insurance policy? We need to be in a position, we need to manage our day-to-day finances properly. We need to make sure that we have sufficient cash flow within our economic system so that we can properly fund a life insurance policy. And I don't care if it's life insurance, I don't care if it's a 401k, IRA. If you are not financially positioned, if you do not have your safety bucket, if you're not properly structuring your finances, no matter what it is not going to work for you. So what I do in the life insurance wealth building class is I give you the financial plan, the financial framework that you're going to need to help you plug the life insurance policy into your financial plan to help you build wealth, okay? But there's going to be a whole bunch of other stuff. Again, this is the preliminary. If you want to do a deeper dive, there should be a link either at the bottom of this video, could be on the video, could be at the side, I don't know. Wherever that link is, it says register now. Click that link and that will take you to the registration page where you can register for either an in-person workshop or a virtual workshop. Now, I will say this, the virtual workshops are held each Saturday from 12 noon to 4 p.m. Eastern Standard Time, and that is excluding holidays, okay? I do travel quite extensively, so if I am traveling, typically you might see a recording, so 12 to 4. Now, you may say, oh, that's a long workshop. That's long, Jerry. That's real. Let me tell you something. Let me say this. This is another thing I'm going to say. People complain about, oh, well, that's a long workshop. Not everybody. But let me just say this to you. If I told you that I had season ticket passes to see LeBron James at the LA Lakers play against the San Antonio Spurs, and that game, how long are those games? 4 or 5 hours? How much of that is actually helping you secure your financial future? That's why I don't make any excuses for my workshop. My workshops are 3 to 4 hours long, but guess what? When you leave out of that workshop, I guarantee you will know more about financial planning. You would know more about wealth accumulation from that 4 hours than you've learned in most of your life. I guarantee you that. Okay, so if you want to go a step further, learn how to apply or how to implement the life insurance into an overall financial plan to help you build wealth, to help you secure your current situation and create generational wealth. We're going to talk about estate plan, all those other things. Attend the virtual workshop. It's again every week from 12 to 4. Now, again, some of them are going to be pre-recorded. Some of them are going to be live. You can attend there. Also, we are doing in-person workshops that are going to be held monthly in rotation amongst the following metro areas. So if you see your area, your city on the screen, that means that we will be in your area. So depending on when you're seeing this video, there might be a button or something to the right that says register. So again, depending on when you're seeing this video, it might be the virtual workshop that you can register for or the in-person workshop. Now, I will say if you register for the in-person workshop, you will automatically be registered for the virtual workshop, okay? Now, there might be a link at the bottom of this screen. If you are somebody that's watching this and you kind of already been through you pretty much are confident that you can go ahead and get this thing going and you want a consultation with me to kind of guide you through this process, you can actually schedule a consultation by clicking somewhere below this video on this probably is on my Facebook page, on my YouTube page. So if there's a link at the bottom that says schedule your consultation, you can just click that link, go right into a consultation with me. It'll put you to my calendar page. You'll see all of the available days and times. But I actually do prefer that you attend my workshop first because it does give you a lot more detail. Now, I did go into a lot of detail today, but I really think that you would benefit from attending the workshop because again, I'm going to go into a lot more detail. I think a lot of people put the cart before the horse. I think, there's a saying that goes, some people have what's called the shiny object syndrome. The shiny object syndrome is every new thing that your girlfriend tells you about or your homeboy tells you about building wealth, you jumping into it and you're trying to do this and do that, do this, but you don't even have the foundation down yet. You don't even know how to get out of credit card. How are you going to find the money to get out of your credit card debt? How are you going to find the money to pay that car off? Because if I can help you find the money to do that, guess what? All that extra money can be going into your insurance policy. All that extra money can be going into your other investment things that you're doing to help accelerate your wealth creation process. So what we're doing is building your financial house, but we got to start with that foundation first. Wealth building is a process that consists of many parts. This life insurance piece is probably one of the most important parts, and that's why we use that as sort of the lead-in point, but there are other things that you need to get. So again, register for the workshop. There should be a link either at the bottom of this video. Schedule your appointment if you want a consultation with me. You can actually, again, do that at the bottom, or there should be a link somewhere around this video for you to join the virtual or in-person event. Click that link. We will send you a text message when it's time to join the class. Again, each Saturday from 12 to 4. Thank you all so very, very much. Be blessed. See you on the inside.